Tax loss harvesting is a powerful strategy that individual investors can use to reduce their tax liability and improve after-tax investment returns. By strategically selling investments that have lost value, you can offset gains elsewhere in your portfolio, potentially saving thousands in taxes. Here's a closer look at the key benefits of tax loss harvesting and how to make it work for you. The primary benefit of tax loss harvesting is the ability to offset capital gains. When you sell an investment at a profit, you trigger a capital gains tax. By selling an underperforming asset at a loss in the same tax year, you can use that loss to reduce or even eliminate the tax owed on gains. Short-term losses first offset short-term gains, which are taxed at higher ordinary rates. Long-term losses offset long-term gains, which are taxed at lower capital gains rates. Excess losses can be carried forward to future years. If your capital losses exceed your capital gains, you can use up to $3,000 per year, $1,500 if married filing separately, to reduce your ordinary income. This deduction can lower your overall tax bill, even if you don't have any capital gains in a given year. Any unused capital losses can be carried forward indefinitely to offset future gains or income. This means your losses today can continue to provide tax benefits for years to come, especially helpful in volatile or down markets. By managing your tax liability with harvesting, you retain more of your investment returns over time. Even if the market is flat or down, tax loss harvesting can provide a silver lining by turning a temporary loss into long-term financial gain. You don't have to permanently part with a particular asset class. You can maintain your portfolio's exposure by reinvesting the proceeds into a similar, but not substantially identical investment. This allows you to stay invested while still realizing a tax loss. For example, sell one S&P 500 ETF and buy another S&P 500 fund from a different provider. Sell a tech stock and buy a similar one in the same sector. Just be careful to avoid the IRS wash sale rule, which disallows the loss if you buy the same or substantially identical security within 30 days before or after the sale. Tax loss harvesting is especially valuable in high-income years, when you may be subject to higher tax brackets and the 3.8% net investment income tax. Offsetting gains during these years can result in significant tax savings. Tax loss harvesting isn't just for wealthy investors. It's a smart strategy that can benefit anyone with a taxable investment account. However, it does require careful planning and attention to IRS rules. At SK Tax Associates, we help clients integrate tax loss harvesting into a personalized tax strategy that aligns with their long-term financial goals. Contact us today to learn how we can help you make your losses work in your favor.